Welcome back to Accounting with Ellis. If you've ever heard of financial statements but aren't sure what they are or why they matter, you're in the right place. In today's video, I'll give you a beginner-friendly breakdown of the three main financial statements: the balance sheet, the income statement, and the cash flow statement. And to make it super simple, we'll use a classic example of a lemonade stand to show you how these statements work together. Let's dive in. First, let's define what financial statements are. Financial statements are reports that show a business's financial health, whether you're running a lemonade stand, managing a small business, or analyzing a big company like Apple. Financial statements help you see 1. What you owe and own, 2. How much money you're making or losing, and 3. Where your cash is going. There are three main types of financial statements, and each one tells you something different. Let's start with the first one. The balance sheet. The balance sheet is like a snapshot of what a business owns, what it owes, and what's left over for the owner. It follows the equation assets equal liabilities plus equity. For example, let's say our lemonade stand has assets of $100 in cash from selling lemonade, liabilities of $30 that you owe to your friend who lent you money for the supplies, and equity of $70, which is what's left over after you subtract liabilities. The balance sheet shows that everything balances. $100 of assets equals $30 of liabilities plus $70 of equity. It's a quick way to see your financial position at a specific point in time. Next, we have the income statement, also called the profit and loss statement. This report shows how much money you earned, what you spent, and whether you made a profit or a loss over a period of time. For example, our lemonade stand sold $200 worth of lemonade in 1 week, but you also had expenses, $50 for lemons and sugar, $20 for cups, and total expenses altogether of $70. To find your profit, subtract expenses from sales. $200 of sales minus $70 of expenses equals a $130 profit. The income statement tells you how well your business is performing. It answers, did I make money or did I lose money? Finally, we have the cash flow statement, which shows you where your cash is coming from and where it's going. This is different from the income statement because it focuses on actual cash movement, not just profit on paper. For our lemonade stand, cash coming in is $200 from lemonade sales, and cash going out is $70 for our supplies. Your net cash flow is $130, meaning you have $130 left in cash at the end of the week. The cash flow statement is super important because a business can look profitable on paper but still run out of cash. For example, if you don't collect payment for your sale, you could struggle to pay for supplies. Here's a quick trivia question for you. Which financial statement is the most important for investors? Is it the balance sheet, the income statement, or the cash flow statement? Well, the answer is many investors consider the cash flow statement the most important because it shows a company's ability to generate cash, pay its bills, and grow. Drop a comment below and let me know which statement you think is the most useful. Here's a quick recap. So the balance sheet shows you what you own, what you owe, and what's left over for the owner. The income statement shows if you made a profit or a loss. The cash flow statement shows where your cash is coming from and where it's going. Together, these three financial statements give you a complete picture of a business's financial health. Now that you know the basics of financial statements, you're one step closer to mastering accounting. If you enjoyed this video, hit that like button, subscribe, and turn on notifications so you don't miss future videos. If you have any questions, drop them in the comments and let me know which statement you want to learn more about. Thanks for watching, and I'll see you in the next video.